I just went through Vanguard's new 114-page report, which analyzes data from 5 million of their 401k and 403b customers to uncover the biggest trends among these investors. Are they rich? Are they broke? Are they saving enough for retirement, or are they investing in the worst funds possible? Let's find out. Yes, I printed all 114 pages because I hate the environment. Average and median balances overall are up compared to the previous year by about 19 and 28%. This all checks out because the market was down in 2022 and up in 2023. It also helps that in 2022, these people were continuing to invest into their accounts even though the market was down, which played a part in boosting those balances in 2023. Making sure we don't let up on the amount that we're investing during market downturns is something to always remind ourselves of.
Oh, I am. I'm only burning my half.
It's easy to say, but a lot harder to do when negative things are going on in the world. Throwing money into an index fund that's going down in value sounds like something a crazy person would do. Later in the video, when we look at savings rates over time, you'll see how these investors reacted to the 2022 market downturn. But there's two main reasons it's extremely important to keep a steady flow of contributions into your retirement accounts when the market is trending down. First, since prices are low, you can buy more shares of your favorite index fund or ETF. Once the market recovers, your money will compound faster. Now, this isn't a reason to time the market by waiting until it goes down to invest, but it is a reason to avoid lowering contributions to your retirement accounts. The second reason is a psychological impact called the contribution effect, which has two benefits. First, regular contributions help maintain or even grow the account balance despite a falling market, making the negative impact of declining fund prices less obvious. You might hear that the market is down 20%, but if your account is only down, say, 12% because you've continued to buy more shares, then you're not going to feel as bad. Second, it strengthens your discipline for long-term investing by reminding you to continue contributing money regardless of what's happening in the world. Staying the course for decades will result in more wealth than frequently changing your strategy based on the latest negative news. Before I show you the balance breakdown by age group and income, here's the percentage breakdown of account balances by different ranges. Looks like the biggest drop came from accounts with less than $10,000 in them, and everything else increased from 2022 to 2023, which is a great trend to see. Accounts with at least $100,000 has increased to 30% compared to 26% last year and since 2014, but still hasn't fully recovered since 2021. $100,000 invested is one of those amounts that can be life-changing because of how much it turns into over time. At a 7% average annual return over 30 years without contributing any more money, it turns into about $761,000. Getting to that first $100,000 can take some time, but once you do, you hit a different level of compound interest, which is fun to watch grow. Looking at the account balances overall tells us one story, but breaking that number down into different income and age subgroups tells us a more realistic story. Because you gotta think, it's a little unfair to expect someone in their 20s to have as much saved as someone in their 50s, or even someone earning $30,000 versus someone earning $100,000. As you'd imagine, people with higher incomes often have larger account balances because having more disposable income makes it easier to save more. Notice how the average account balance of people earning less than $15,000 is higher than the next income level up. My guess is that there's a few retired people with larger balances who earn some sort of income on the side. Since I'm interested in how things trend over time, I wanted to compare this data to the previous years, and I was actually pretty surprised at what I found. Because the average and median account balances were up overall compared to the previous year, you'd think we'd see the same thing when the numbers are broken down by income. But this wasn't the case. For the people with incomes of less than $30,000, the average and median balances increased for the most part. But for everyone else with higher incomes, their balances declined, even with continued contributions and the stock market ending the year up 24%. It makes me wonder, do these people with lower incomes really drive those overall numbers higher? I have no idea why this happened because I don't have access to that extra data that might tell the story. So if any of you have thoughts or ideas, then feel free to share them down in the comments below because I'd love to hear what you think. If account balances are broken down by age, we see improvements across the board when compared to the previous year. Not only did the average and median balances increase, but look at the percentage change when comparing the average and median. Since all of the median balances increased at a higher rate than the average, that tells me that the distribution of balances is becoming more evenly spread, with fewer extreme outliers or large balances disproportionately affecting the average. As a reminder, the reason we see such a big difference between average and median balances is because the small number of accounts with very large balances skews that average amount way above the median. Think about it like this. You could have 10 people in a room, each with account balances of $10,000, which would make the average account balance $10,000. But if Warren Buffett walked into the same room with his $131 billion, then the average account balance of the room would be around $11 billion, even though 10 of those people only have $10,000 in their accounts. Median balance is better to pay attention to if we have access to the data because it represents the typical account holder. Half of all participants have balances above the median, and half have balances below. Before I show you savings rates, how these people invest, and a few other things, also keep in mind that we should take these account balances with a grain of salt. Since this report only covers Vanguard 401ks and 403bs, if these investors have any non-Vanguard retirement or investment accounts like 401ks, taxable accounts, HSAs, Roth IRAs, or whatever, then what's in these Vanguard accounts should be considered the bare minimum that they have invested for retirement. So don't go looking at all of these numbers and assume that they're all way behind on saving for retirement. The average savings rate increased slightly to 7.4% compared to the previous year, while the median remained the same and was down from 2 years ago. The percent of a person's income invested into their 401k or 403b is usually referred to as the deferral rate, but I like savings rate better, and this is my YouTube channel, so that's what I'm calling it. Your savings rate is an important number to know because, as I recently taught my 6-year-old niece, it doesn't matter how much money comes into your life if it's going right back out the door, since you like to spend it all on toys and candy. If you want to figure out what your personal savings rate is, then you can get a free copy of my spending review spreadsheet to calculate that down in the description below. And don't forget to help support my little dog Molly and the free content on this channel by hitting that thumbs up button. When we look at savings rate by income, there's a couple of observations that I want to point out. First, higher incomes correlate to higher savings rates for incomes of $50,000 and above. But that doesn't mean that they're immune to decline. As you can see, the savings rates for most in the 4 highest income groups have declined since their peak in 2021. This could be due to a lot of things, but one thing that did happen in 2022 was the market declined by roughly 19%. I'm hoping these investors didn't cut back on their contributions because of this, since, as I mentioned before, it's the best time to stay the course with the amount you're investing. It could have also been due to inflation. In 2021 and 22, the cumulative inflation rate was about 14%. Maybe inflation had caught up to these investors, which forced them to reduce their contributions to cover increased expenses. Looking at how savings rates have changed compared to 10 years ago, people in the $30,000 to $74,999 range are saving less, which isn't very encouraging. One thing to note here is that these numbers don't include contributions from their employers through a matching program, which would boost all of them up a little bit. I don't have the numbers broken down by income, but overall, when we include employer matching, investors are contributing more today than 10 years ago. Vanguard mentioned that a typical saver should target contribution rates of 12 to 15%, including their employer match, and only 49% of participants were actually doing this. Before I show you how these people invest, there's 2 more very interesting things that I want to show you. The maximum amount that you could contribute to a 401k or 403b in 2023 was $22,500, which I think we can all agree is a decent chunk of money. As you can see, the people who achieved this didn't creep above 1% until we hit the $75,000 income range. And even then, only 3% of those people actually max out their accounts. Heck, even when we move up to the next income range, only 13% of people were maxing out these accounts. If you ever hear about people maxing out their retirement accounts and feel like comparing yourself to them, remember this graph. While it's possible to do, and I encourage you to try, it's not normal. These people are super saver outliers, so it's dumb to try to compare your situation to theirs without knowing the details of their personal life. When we look at the numbers based on age, the percentage of people in the 35 plus cohorts are around the same. Congrats to all these people, because contributing that much money is not an easy thing to do. 93% of these 5 million investors had a Roth option available to them, and only 17% actually used it. I was a little surprised to see how few people with lower incomes utilized this type of 401k and 403b. Lower income years are the perfect time to pay those taxes up front, so you don't have to pay them in the future when you are possibly in a higher tax bracket. Although if people in those lower income groups are tight on money, then I could see why they might want to contribute to a traditional 401k to reduce their taxable income today and free up some extra cash to cover expenses. Based on my personal experience, knowing when to invest in a traditional versus Roth 401k is one of the least understood concepts among a lot of people I work with. Now, I wouldn't be surprised if these investors are automatically opted into a traditional and don't even think about changing it. Over the past 10 years, the amount invested into equities has stayed fairly steady, but it's currently at all-time highs with 74%. Target date funds continue to eat the world since they've been on a continuous rise since 2014. This has a lot to do with the fact that employees are usually automatically enrolled into target date funds when they get hired. It's not the most ideal fund for younger people who can take on more risk, but it's better than them not investing at all, so I can't complain. If we look at it from an asset allocation by income standpoint, as investors start increasing their income, they increase their allocation to equities and decrease target date fund holdings. The same pattern shows up when we look at asset allocation based on age as well. Younger people probably realize that they want to take on more risk by investing in stock-based funds to unlock higher potential returns. If we look all the way to the right, as older generations get closer to retirement, median equity holdings starts to decline, which checks out. If you're like me and invest in 100% stock-based index funds, then we're the group of people that Vanguard calls extreme equity allocations, which sounds way more hardcore than it actually is. Here's the distribution across different allocations. We only make up 5% of the investors, and the largest group is in the 81 to 90% range, which is still pretty darn aggressive. What's even more interesting is how stock exposure has changed over time based on age group. Check this out. Investors 25 and older have done nothing but increase their exposure over the past few years. Look at that. This is even happening for the people 65 and older who you'd think would be reducing their stock exposure. Maybe they came across the research on investing in 100% stocks that I covered in a recent video, which you can watch to your left next. Hit that thumbs up button before you go. I'll see you in the next one, friends. Done.